Hello, everybody. A warm welcome to another edition of our Across Retail Talk. It's the first one we have in 2024, but you can be sure it will definitely not be the last one. My name is Reinhard Winivater. I'm the publisher of Across magazine, and I'm very pleased that so many people across Europe are here today. Our topic, very, very interesting. We will have an investor's view on the placemaking industry. A top-class discussion group is ready. Klaus Striebich will, as usual, lead this discussion as our expert moderator and also as our master of ceremonies. Yes, and you can and you should take part in this discussion by using questions and using the chat function. In the next few days, we will send a summary and a video of this discussion via our newsletter, our website, and our social media channels. Before we start, I would like to mention two things from my side. First of all, Steffen Hoffmann, congrats to your company anniversary. 10 years Ambers Real Estate. Congratulations to this really great success story.
Thank you.
Yes, and the second point is I want to draw your attention to our Across study tour from April the 17th to April the 19th to Istanbul. We have only 3 places left. All information can be found on our website. Maybe someone of our today's audience wants to join us. We have a really great program prepared. So that's it from my side at the beginning. I now hand over to Klaus Striebich. And yes, Klaus, the stage is yours.
Thanks very much, Reinhard, and a very warm welcome also from my side. And I hope you have had a very good start in 2024. Yeah, the real estate industry is faced a huge number of challenges so far. We see a lot of changes in customer behavior, exogenous shocks, economic expectation do not really fit to our needs. And no doubt for us, a going concern these days is not longer valid. And many things have to be changed, have to be adapted from other business to our business. And yes, it will be extremely interesting to hear how the investors market in retail real estate looks like. We have several questions which we have to discuss with our top-notch panel here. So where do we have to head to? Where do we have to invest? What do we do with our current portfolios and assets? What has to be done in the next few months and years, not only to survive, but also to succeed? I'm very happy having these panelists in our discussion today. And I will start with, and all of these are for colleagues, and we have lots of common experience, which is absolutely nice to see. I would love to start with Rüdiger Dani, my former colleague, now CEO at NEPI Rockcastle. Rüdiger, it's nice to have you with us. And please give a little intro, what you are doing, where you are based, what are your backgrounds, and what's NEPI Rockcastle doing?
No, absolutely. Thank you. Well, thank you and welcome, everybody. Thanks for joining today. So I'm Rüdiger Dani. I'm the CEO of NEPI Rockcastle. It's a stock-listed company that is operating in Central Eastern Europe, approximately 60 assets, 60 shopping centers that we are operating across 9 countries, some like 6.8 billion euros NAV that we're operating here. But we are not only an operator, we're also an investor, and we are also a developer within the region. So we also have a decent development pipeline. So that's in a nutshell about NEPI Rockcastle. But actually, as of today, we have published our annual report. So if you want to know more about that company, you just look it up on the internet.
Yeah, super. Give us a little bit more insight about the countries where you are in. So you are in a kind of a half moon in the eastern part of Europe, which is a somewhat special issue. Where are your major markets at the moment?
Well, 36% actually of our portfolio is located in Romania, and another 28% is located in Poland. So these are, let's say, the 2 heavyweights. But we also have an asset in Lithuania, Ozas in Lithuania. We are in Czech Republic, we are in Slovakia, we are in Croatia, and we are also very well operating in Bulgaria. So in total, we're covering actually this whole region all the way from the Baltics down to Bulgaria, Croatia.
We will come back to that direction, whether it's an advantage or a disadvantage, where to be located and where to be invested. Thanks for that, Rüdiger. We have with us Stefan Hoffmann from Abbas Real Estate, 10 years anniversary. Congrats from my side as well. You are the middleman, as I would say it to you. What is the task and I would say the service of Abbas Real Estate? Give us a little insight, please.
Yeah, thank you, Klaus, and Rainer, thank you for your kind congratulations. And yeah, we are a small boutique advisory firm, and we focus on real estate transactions, retail real estate transactions, and mixed-use transactions, but also on strategic asset management advice. We are based in Germany, which is our home turf, our home market, and the lion's share of what we do is on German ground, where we work with domestic investors, but also with foreign investors. But we also travel with our investors to other countries. And so my company, since we've launched, has now worked in 10 different European countries on top of Germany. At the moment, we work in other markets such as Austria, Spain, Italy, and of course, in Germany.
Super. Thanks for that. And we will listen what you could give us as some insights or key takeaways from your side. And I'm very happy to have one of my former colleagues with us. Volker Kraft is Managing Director at ECE Real Estate Partners. He has launched this company, this pillar of ECE Group, many, many years ago. Volker, thanks for being with us and give us a little story and insight, what you're doing so far and what are your focuses are at the moment.
Thank you, Klaus, and thank you, Reinhard. It's a pleasure to be on the Across panel for the first time. Very happy to join the group and share some insights from the investment markets. I'm running ECE Real Estate Partners, which is the investment management arm of the ECE Group. We are investing in shopping centers across Europe. Home market is Germany, but we're also active in Poland, in Denmark, in Italy, and Spain. In total, we're covering 7 European markets. We do have approximately 10 billion of assets under management in closed-ended and open-ended funds and separate accounts. And we do invest money from the Otto family office, which is one of our anchor investors, but 90% of the capital comes from institutional investors from across the globe, pension funds, insurance groups, sovereign wealth funds. And we've been doing that since 2009, so for approximately 15 years in this setup. In addition to running ECE Real Estate Partners, I'm serving on the board of directors of Deutsche Euroshop, a public German shopping center REIT, and on the board of Alosh, which is the largest South American shopping center REIT with approximately 60 malls under management in Brazil.
Super. And you're doing it successfully, as I know. And we should not forget to mention that you have also international expertise with your knowledge found in US and South America. So that's great to listen. Maybe you have some insight from that markets also for our market, if you allow. Super. Thanks for being with us. So you're all back from MIPIM. So last week's MIPIM was the most, I would say, important fair or exhibition in our industry. Many REITs, many social media content has been showed up. What is your impression? What is your key takeaway? What is your view and feeling from that fair? Rüdiger, with what kind of, let's say, mood have you traveled back home from MIPIM?
Well, especially, let's say, from our perspective, from NEPI Rockcastle's perspective, we came highly motivated back to Bucharest. We see a lot of opportunities. We see more opportunities in the market than challenges. I think we come to this a little bit later. But I think there was not a mood on this fair, because it was really very much depending on whom are you talking to, what kind of part of the business somebody comes from, and especially what kind of region somebody's located and doing this a little bit later. So I think there is a big spread here, what at least I witnessed, with really almost to depression to all the way to being very excited. So I think that's really a mixed bag, and the market is a little bit splitting apart there. just to put it, let's say, to put it like this.
And how does it come that you see more opportunities than challenges? Is there more things to invest, or is there that kind of positive prediction outlook for Romania?
Well, I think that, yeah, it's very much related, obviously, to the spread that we currently see in our business, in the shopping center business, that you see Western Europe is really stagnating or even going in the wrong direction. Germany, let's say, moving more or less into a recession. Very bad mood and very bad news around let's say, GDP growth. So that's something that is, I think, a little bit more on the let's say slow side. If you look at Central Eastern Europe, that market is totally outperforming Western Europe at the very moment. The fundamentals, the basically fundamentals, economic fundamentals are very different, and our industry is profiting there. So we have seen double-digit growth over the last 2 years. We had a strong demand here by retailers moving into these countries. So the mood obviously is very different when we look into also the appetite of investors into that region, when we look at cap rates in those regions, which are really spreading apart. And that's, I think, a fundamental difference here. And that's why you would also see that the mood is different.
Volker, that's a great opportunity for you to jump into that market, right? Or what is your key takeaway when you came back from MIPIM? What are your thoughts about it?
No, absolutely. And let's say I'm cautiously optimistic. And so the conversations I had with financing partners and investors, I think the general conclusion is that investors agree that it's a good time to invest. We have seen the repricing in retail in particular. There's more uncertainty in other sectors with probably more repricing to come. But I think there's a general consensus that it's an attractive time to buy retail in general. And that's probably a window of opportunity for 2 to 3 years. However, there's a lack of equity. There's a lack of equity. To a certain extent, this creates the opportunity. So there's a lack of equity because many investors are over allocated to real estate to begin with, struggling with additional investments in existing portfolios. I think this creates huge opportunities for those that are willing to commit and those that have funds available. So in general conclusion, some great vintage years ahead of us, but it will take some time until we see transactions materializing. It's still pretty dry.
Interesting. I think we should come back to that fight for capital allocation later, the day what have to be done. So Stefan, you are the guy who is between those one who buying malls and those one who are purchasing and selling malls. What have you found out during your stay at MIPIM?
Yeah, not only malls. So, it's also that we look into the retail park sector and the outlet mall sector, and we try to collect data points at such an event. And we came home, and it was an absolutely positive MIPIM for us. And I think the reason I would rate it like that is when we think back, 2022, MIPIM was just a couple of weeks after Putin attacked the Ukraine, and everybody was shock frozen. And 2023, I remember there was Silicon Valley Bank. The event was just the weekend before MIPIM. And suddenly we had a big banking crisis in the newspaper where a major Swiss bank got bailed out actually while we were at MIPIM, and the market was shaken. We also had the developers that, they knew they have become under pressure, and there's, nobody who laughs about that. It was just very complex through this rapid change in interest rates, and it was a difficult setting that was not easily to digest or to solve quickly. It still isn't. I think I see as many risks as I see opportunities, but which is a completely different picture from last year, where everybody only stressed the complexities and the problems. And now we have seen a price correction, a severe one, actually. There's no fact in hiding that. So the cap rates of 2016, 17 are not the cap rates we talk about today when we talk about retail or in particular shopping center investments. But we have seen the price corrections that other asset classes go through at the moment. We have mastered the COVID-19 storm. KPIs for many assets show a resilient trend, which is positive, and investors feel that they can price the risk and opportunity of retail again, which makes it interesting going forward, because if you come in at a completely different cap rate, you also have some leeway to manage some income risks over time, and the income outlook is not too bad. So we were positive, and I think sunshine helps.
That's what, indeed, absolutely. So, and it's good for the tanning as well. So, thanks for that, for your images and your impressions you brought from IPIM to the audience. But let's dig a little bit on this number of challenges so far. As I understood Volker correctly, we have reached the bottom, which is good. So we don't see, let's say, any falling any longer. So having a bottom, or let's say fix the bottom, it's a good starting point. And we are seeing some light at the end of the tunnel, and it's not a freight train coming against us. So, but still we have some struggles with some, let's say, increasing construction prices. We have still a high, let's say, interest rate. Volker mentioned the lack of equity. I think that is a huge impact. This is, and of course, still a kind of, let's say, pressure on, let's say, rents or rental income stream. I think there is a kind of, let's say, rebouncing on the one hand. On the other side, there's still a lot of pressure in the market. How to handle all these challenges at the same time? Is there light at the end of the tunnel? Is there a need for much more, let's say, operational excellence? Is there need for much more workload to be done? What is your view? And is that a big change in your daily work, Rüdiger, or what are you doing with these issues?
Yeah, let's take it maybe one by another. It's quite a bunch of flowers here. So I think financing. Let's look on the funding side. See it a little bit different than Volker, as maybe also because of the region we're operating in, maybe also because we are a stock listed company, an investment graded stock listed company. So I think it depends very much on really which company is looking for funding here and what are the reasons for it. So what I at least see is that on the bond markets have reopened. That is for us very important, because this is obviously a source of funding that is not encumbering our assets. So that has been reopening, and actually the interest rates has been moving in the right direction. We're looking forward to, let's say, the summer. I think we're all hoping that the ECB will go down further with interest rates. So that opens for us an additional resource of funding, which we are used to, and which was closed actually over the last 12 months. So there were no transactions actually. So that's positive. And also, Volker, looking at the equity side, when I look at the latest equity raises, issuings that have been taking place in the market, which were quite heavily oversubscribed out of different reasons. I know the majority still was more to let's say, to repair the balance sheet. But we also see now with Segro, for example, coming to the market, that those companies that have a growth story to tell in real estate, and this is not related so much with Segro, with retail real estate, but in general with real estate, investors are coming back to, as you said, to real estate. Look at how many times these bonds and also the equity issuings were oversubscribed. So there is money in the market for real estate. It's just very selective. The money is very selective on where do we invest in which company or which asset class we are investing into. So it became definitely more selective, or is still very selective, but there is a trend, at least as I see, that opens doors for funding than closing. That's how I see it on the funding side. On the rental side, again, I'm coming back to the fact that it works a bit different in Central Eastern Europe. We have seen an uplift of our base rental uplift over 2023 of 7.5% above inflation. That has simply also to do with the fact that salaries, purchasing power has been increasing more actually than inflation. So, and people are spending. I mean, it's also a different mentality. A German would say, oh, wow, my money is less worth tomorrow. Let's save it so I can pay the rent in I don't know, 6 months' time. In Central Eastern Europe, people have a different opinion on it. They went through more crisis, a bit more resilient, and they would rather say, "Wow, our money is less worth tomorrow. Let's spend it today." You know, so that's also a bit of a different mentality, I think, within the markets we are operating in. So that's just on these two topics. Of course, construction costs went up big time. I would say in the last 15 months, is some 20%. That's for a developer, as we are, let's say, of course, a challenging situation. But on the other hand, one has to say, if you cannot compensate it on the income side, if tenants are not ready to pay for new developments, then simply leave it. I mean, just don't go there. We still have that pipeline, and we feel quite sure that we will achieve the yields that we're looking at. But that has been definitely a challenge that we see as well over the last 12 months at least.
Mm-hmm. I love this word that the money is there, but it's selective. Volker, what is your view? What has to be done that this money is found or is finding your assets and your offers? Is there any additional need for it in operation or in management of the assets and the portfolio?
Let me also touch the various points that you raised. So first of all, financing. With respect to debt, I totally agree. The market is wide open. The bond market is red hot. Everybody issuing bonds at reasonable rates. The mortgage market is open. Banks are selective, but they've always been. So that's okay. Mortgage market is open. We don't have restrictions on the debt financing side. I think what is the bigger challenge is on the equity side with the large shopping center REITs, many of them still trading significantly below NAV, which makes it tough to do a capital increase without being like really dilutive. So many of them still repairing balance sheets and rather selling than acquiring assets. And when it comes to the private investors, pension funds, sovereign wealth funds, etc., they've increased their allocations to real estate over the past 10, 15 years to very high quotas, 25, 30% for some German pension funds, close to the regulatory barriers. So it's tough for them to take advantage of the market situation. Nordic capital, Anglo-Saxon capital is more readily available to take advantage of the situations. This is what we see. And I think this was probably what's going to drive transactions to begin with. First, the opportunistic buyers come, then the value-add buyers come, and core comes last. This is what usually happens in a market situation like this. On the operating factors that you described, we actually saw a pretty healthy rebound of sales across our portfolio, across all countries. Southern Europe slightly stronger than Northern Europe. That all goes with GDP developments in line. But it's interesting that consumers, in difficult times, they hold back on consumption, yes, but typically on large stuff. They hold back on buying a new car. They hold back on refurbishing their apartment. They hold back on buying a new kitchen. But they treat themselves with a nice little shopping trip in our shopping malls. And I think, so overall, shopping mood is okay, actually. It's okay. We see it in the numbers all across Europe.
Super. Do you see any special question, and difference between the so-called closed fund investors or the stock exchange listed investors, or those one who are investing in shares in stock exchange companies? Is there a difference to be seen? You are also in Deutsche Euroshop listed on stock exchange.
I mean, absolutely, it's two completely different groups of investors with small overlap. I mean, the stock market offers very, very attractive pricing still implied yields much higher than what we see in the private markets. So you'd probably see opportunistic and investors coming to the stock markets. We kind of took advantage of the, say, mispricing when we took over Deutsche EuroShop together with Oaktree in 2022. And there's still a huge gap in pricing between public and private markets. But again, also private markets comparatively are have found a bottom, and however, private investors tend to be highly allocated to real estate as such. The good thing is the retail bashing is over. So we've been through like 5 tough years of retail bashing. This is history. People are looking at retail, all segments, all countries, because of the attractive pricing. Now it's about office bashing. Okay, this will again last 5 years, and it's tough to be in such a position, as you all know. But so I think general sentiment on retail has improved a lot with all of investors, which is the good news. Overall, sentiment on real estate is still tough, which is the bad news.
Interesting. Stefan, do you think we see a kind of, let's say, new IPOs in the retail real estate market? We have just a little number of, let's say, companies listed on stock exchange. Most money is invested in closed fund or in open-end funds, but less in stock exchange. We have 2 examples here who are at stock exchange listed. What is your point of view on that?
Well, let me go one step back. So not only when you look at the stock exchange, so there are a number of REITs which we regularly monitor, and which actually is a quite interesting exercise because they represent hundreds of shopping centers in Europe altogether. Yeah. So instead of following one individual asset, you can follow a few hundreds, and if you do that month by month, you see something. And many of the REITs have recovered substantially from the lowest point in the market, which was probably just shortly after the outbreak of COVID-19. But still, they are all trading well below the peak times. We know that, and I think it's not, we don't need to cry over split milk, and the good old times in that same sense won't come back. We have to deal with what we are faced with, and it's a complex setting, but still, it's a setting where relative against other investment opportunities, the investment market at the moment says again, I find retail interesting. And people we've talked to at MIPIM, for example, are large opportunistic or added value funds from the UK or the US. And here, Rüdiger, I have to disagree with you in one point, and I know that the CEE countries, they have a more robust performance than what we've seen in Germany, for example. But that macro setting for Germany, that is something that motivates foreign investors to look at our country at the moment and invest, because cap rates have moved to a level where they've never been to. And our whole environment and society is at the moment in a bit of a shaky place. And some people find that interesting because they think the Germans will handle that. They will manage it. That country will be strong again. And, our infrastructure is in place, and we are surrounded by 10 European neighbors and are a country which will be an export nation. So there are many, many things which at the moment get overlooked, where the underlying fundamentals for retail real estate are not really bad. When I was in school, people told me that about that time we would have 78, 79 million inhabitants. Now we have 84 million inhabitants. That's 5 million more. So complete misprojection. We know it was a crisis that led to this. But again, some things may make Germany more interesting than we see at the moment in the newspaper. And another market, which is not in Eastern Europe, I appreciate the Eastern European markets a lot, in particular Poland, Hungary, where we've been active as well. But look at Spain. The Spanish economy hold up very well. And there is investment activity in the Spanish market. Shopping centers are outperformance. There is footfall, there is growth in sales. The economy is more robust. When we look at Spain 2008, 9, 10, when whole Europe had a crisis, Spain fell and had a huge unemployment rate. At the moment, Spain is holding up very well. low unemployment rate in historic comparison, and a robust economy in terms of GDP growth. So I think there are opportunities, and I'm really encouraged by the MIPIM feedback in this respect. And as Volker said, people have stopped laughing. I think people stopped laughing a couple of years ago. You know, the period between 2017 and 2022, that was the toughest because all other asset classes were outperforming. Only retail was correcting. And into 22, we were at one moment all in one boat. And now it looks as if retail is coming out of that crisis earlier than other asset classes. And that's not us laughing about the other asset classes, but just taking advantage of that fact that we have mastered a big part of that storm already, and we should make something out of this.
Thanks for that, Stefan. And I hear that there's a kind of a value in between called trust and confidence to a market situation that leads to that point. But Rüdiger, I think you have something to comment on that.
No, actually, I was. I think I didn't. I hope I didn't do any Germany bashing here. I am German, and I would love to see that the German economy, and I think especially, let's say, the overall mood gets more into a mood of, okay, lass uns die Ärmel hochkrempeln. So let's roll up the sleeves and move things forward. And that's maybe what somebody could be missing, being a German living outside of Germany. But I think, yes, of course, you have seen there the correction in cap rates, and you will have more, let's say, opportunistic money moving into Germany most likely. So I wish all everything good on that sense. And I think, of course, Germany will recover. We have been called, if I may say, been called the sick man in Germany already years before, and it seems to be the second time now. And I think we got pretty good out of that, and we'll do it again. So I'm not seriously worried there about you guys in Germany. It's like, and you're right. Looking into Spain, where you also see GDP growth is outperforming most of the other European countries, as we see that in Central Eastern Europe, that makes a big difference. But it shows you also that this is not really United Nations of Europe. So it's still so volatile throughout Europe. And I've seen the latest, let's say, also deals that went that were closed actually in Spain. Also cap rates in comparison actually to the performance of retail there in total. I think it's still a very interesting market also to look from an investment point of view. While I'm not saying this as NEPI Rockcastle because we will stay within the regions we are in. But just observing the market, that's another interesting market at the moment. So, and yes, absolutely. And I think this is really good news that we also see on the stock listed side, the bigger players like Unibail, like Klépierre, they are all like all of them are actually moving upwards. Unibail, first time coming in with a small, but coming with a dividend to pay. Operational numbers are improving. And I think this is generally for the total industry good news, because it shows that, as you said, if an industry survives, let's say, what we have been going through over the last years with COVID, and then, let's say, with this kind of hike in interest rates, and everything that we've been facing, it shows actually that shopping centers definitely have a reason to be here also in the next 10 years and 20 years. So, and that's the good news. And that's obviously, I think, what investors have already been witnessing, and it comes stronger with every year.
As a short wrap up, I would say the outlook, the prediction is positive, it's more than positive. So despite the fact that there's lots of things to do anyway, undoubtful challenges have been always appeared. And the good thing is all the real estate managers have always managed these kind of challenges, which have been seen throughout decades. Let's go a little bit to the operational side, if you allow. So in the very past, the secret of success for retail real estate was a kind of, let's say, financial engineering, which was nothing else than the gap between, let's say, the interest rates and the cap rates. The gap has been smaller, but how to handle now these assets, the portfolio? What has to be done? Could you manage lower costs and higher rents? Volker, if I may ask you, if there's the gap is smaller between these two numbers, but you're still seeking for good, let's say, results, what has to be done operationally to succeed?
Klaus, I think actually the correction is pretty healthy. We see healthy spreads. We are back to what I would call a normal interest rate environment. It was a bit fast, and that caused a lot of stress in the market. But actually, we do have spreads, positive spreads between financing and cap rates in the retail sector, which is not the case in some other sectors where there's still more price correction to come. And we do have financing available, as we discussed. So with healthy spreads and financing available, but no longer like financing for free, it's back to the days of the operators. I think this plays to the strengths of the operators, groups that can actually work the assets. You earn money by improving the assets that you own, by growing NOI, by leasing it out, by leasing it up, by extending it, refurbishing it, etc. There's so many levers that you can pull in with shopping centers, many more than with other segments in real estate. So I think the market correction kind of is healthy, and it plays to the strengths of operators, and we will see probably some pure financial investors withdrawing from the sector, or at least, I mean, they probably have to team up with operating expertise somehow to take advantage of the current market situation.
So we're still the case of rolling up the sleeves, as Rüdiger already mentioned, and much more to do. And the working day is a little bit longer now, or is it still the same numbers of hours you have to work, Volker?
It's the same numbers of hours.
That sounds good.
24/7. 24/7. The day doesn't get longer.
That sounds good. As always, I have to mention, Stefan, what would you comment to your, let's say, partners? Whether it's a purchaser or a buyer, what to do to succeed with the current portfolio and the assets?
Well, I actually think that we are at a point where investors.
Yeah, business is doing good.
Somebody is in strong demand here. So we are at a point where investor education is necessary again, because if you've gone through this phase, which I call the perfect storm that retail has gone through, people have unlearned the good reasons to invest in retail. And so I see a market phase for us and for many players in the market that have an advisory role, that we educate the market on which assets have a future, and also at what price level deals will become interesting again. The market currently finds a new equilibrium price. So we have more supply than demand. Part of the supply is voluntary, a part of the supply is not voluntary. If there is a deal between a not willing seller but a willing buyer, that always means that the price will be very low, and that cap rate is probably very special and not necessarily representative for the fair market value of an asset. And so we need to look at every asset and help the investment market to form a view on that asset. I think that is one of the main tasks that we need to work on at the moment. Across the board, I think that future cap rates, at least for the upcoming investment cycle, will be somewhat or even meaningful higher than the cap rates that we have seen not only in the previous cycle, but also in the cycle before. So that is just due to the fact that there's a lot of space in the market, and that there was also a disruptive effect of e-commerce. And we are not through all of this, but we can manage it, handle it, and price it nowadays. So investor education is one thing. The second thing is, I think well-timed acquisitions will simply help for capital growth going forward. So if you now wait 5 years until everything is settled again, the price will not be a 6.5%, 7% cap rate. The price will be a, 5.75% cap rate. And it's much more difficult to achieve a double-digit return when you come in at a very high cap rate. So for people who invest in 224, 225, I think that's a perfect window to also work on assets, carry out well-timed asset management initiatives, and exit in a better market environment. Betting on interest rates might be a gamble. It doesn't feel completely unhealthy to assume interest rates of between 2.5% and 3.5% plus bank margins. And so we hope we will get back to this level. And last thought, I think transactions are very, very important for the market. It's not only that, advisors will be paid, there will be advertisement in magazines or whatsoever. Transactions bring fresh capital to the assets. And that is also important, that retail assets, that they get developed further and that you work on the assets. And usually when you have gone through such a phase in the cycle, the pocket to carry out asset management exercises has become smaller. Yeah, and transactions usually have to bring fresh capital and new ideas on the next phase of the business plan. And this is why I'm personally a big fan, a big supporter of transactions.
Super. I like this word of, let's say, re-educating the investors market or the players inside, and also to have a kind of, let's say, smoother, let's say, time point when to invest and when to divest. That's always somewhat, let's say, logic. Sometimes I remain on that topic, back to basic, back to, let's say, the roots of our industry, and that has to also to be taught to somebody in the market to understand it more properly. These days, let me switch a little bit to the agenda. These days, in every presentation is ChatGPT to be involved, and AI has to be involved. And I have also asked ChatGPT, what are, let's say, the winners in our industry? What are the winning formats? What are the things which come up? And I have a kind of, let's say, positive, let's say, prediction. And not surprisingly, the first namings have been mixed use real estate. So not only retail real estate, but more mixed use. Let's talk about this a little. Experiential retailers. Maybe you have a view what this could be. E-commerce integration, something which is also something very specific, sustainability and green initiatives. Sometimes my personal comment, I think we Germans are a little bit overdone, and maybe we can force this question or forward this question firstly to Rüdiger, what his view is on that. Technology integration, for sure. I think our assets are more and more technology driven, and health and wellness. So lots of, let's say, buzzwords. Let's get started. Rüdiger, if you allow. Everybody talks about sustainability, ESG, green initiatives, whatever it is. How do you handle these topics in your portfolio with your view on the market? You're unmuted.
Sorry, everybody. The typical one, right? Now, look, I think that this is not something we all know this. This is not a nice to have or so. This is a total must have. So if you're not fulfilling, let's say, ESG standards in the future, if you're not reaching your ESG goals, you will simply not be bankable. And that's where it comes down to. Even evaluations in the future will run differently. Fair value will be driven not only by the factors that we've seen so far, it will also be very much driven on the same topics, actually. We're moving European Union taxonomy, so all this is moving in. We will have a new reporting standard on this by the end of this year. So I would say at least for companies like us, stock-listed companies at a certain size, this is an absolute must-have. And I tell you, the loan we got from World Bank, IFC, the commercial discussions were rather short. The topics on ESG, that was what was taking the time and was taking the, let's say, a lot more effort to get aligned with. So that is a very important topic, I think, for every industry. And when I'm saying for every industry, I'm also saying for every retailer we're dealing with. We're all facing the same situation here to bring down our emissions and get more efficient here, but not only on the let's say on the energy side, it's also about waste disposal, it's water usage, all of that. So that is a big topic. And what I do understand, of course, is that the first reaction is why why do we need to do this all and it's expensive? Well, besides the fact that we should make an effort to save the planet, NEPI Rockcastle, we have decided in 2022 to take it not only as let's say as a challenge, but also as an opportunity. And we've invested 35 million euros in fully equipping our portfolio in Romania, as I said, which is the biggest part of the portfolio, with photovoltaics on our rooftops. And the latest one that we've opened is a shopping center in Craiova. We opened in October, 63,000 square meters, and we even put on top of the parking a total layer of photovoltaics. So, and that is actually producing 75% of the energy of the total asset is produced on site. And that's good, of course, when we look at, let's say, the ESG factors that we need to consider. Our tenants are very, very happy because they also get, let's say, more and good energy. But at the same time, this is double-digit yielding. So this is a business line for us, which we are putting up as a NEPI Rockcastle energy business that we are now rolling out from Romania into all other jurisdictions. So for us, this is an additional income stream that we are looking into in the future. So why can it not serve both ends? Why can it not be, let's say, to a certain extent, also a profitable business and at the same time meeting ESG requirements? And that was the target actually when we started the whole program. So, and I think that's again also where you said, well, yes, we will have over time, depending on your maturities and so forth. But over time, of course, we will see higher costs and financing costs. This is like normal. But I'm totally with Volker. I think this is super healthy. It also erases all the, let me put it this way, stupid money. So it's more about now. In the past, it was more about just looking at the growth of a company, but not at the profit and loss. And I like the idea that maybe now we're looking more into the profit and loss, not only in market shares and growth. So I think that that's one of the opportunities to deal with ESG. But as you said from your chat GPT list here, I would say also very, very, let's say, more closer to us, new income streams or revised income streams, which is mixed use developments, will play a role. We are now implementing also, we did our first resi development, of course, in combination with the shopping center, 220 flats. I mean, to have it, I think it depends obviously very much on the location and what are you doing there. But in principle, to have, let's say, a mixed use asset, as we, for example, do now here, we invest more than 250 million euros in a project in Bucharest where we have a mixed use of retail, of hotel, and of offices. I think that this differentiation of income streams and risk structure definitely will help us in the future. I think it's a very interesting approach, but it depends really very much on the location and on the, let's say, the total environment, wherever it fits. And it needs to have, of course, a certain minimum dimension. Otherwise, let's not talk about mixed use. Yeah. So I think that's also for us a strategy to move not only into the asset class we are pretty good at, but I think for, let's say, for example, for a developer of shopping centers, with all the complication of that development, to build a, let's say, to do an office building or a hotel is that's not really rocket science. So that can be done. So yeah, I believe that mixed use is also, let's say, definitely a trend that should be or could be an alternative to grow your revenues and to de-risk your portfolio.
I would love to hand over to Volker as well. So mixed use is not a kind of, let's say, trend or pixie dust or whatever. Volker, I know there are certain, let's say, activities also in the easy real estate funds to handle this kind of mixed use. How do you see and how do you handle it from your point of view? What have you done so far, actually?
Yeah. So look, on the mixed use topic, first of all, I think let's keep in mind shopping centers are pretty flexible animals, and they are built and designed to be flexible. And so the whole theme of like turning it into mixed use by bringing in doctors or repurposing by adding some other usages to it. To me, it's actually just exactly what these places are designed to be flexible shells, and whatever happens in terms of change in the overall retail, entertainment, F&B landscape, this is something we can mirror in our places that we own. And I totally agree that this has become much more diverse. So today we see a much more diverse tenant mix than 20 years ago. As I said, including doctors, including wellness, including entertainment concepts that we haven't even heard of or dreamt of 20 years ago. So I think sometimes it's confused in the way that, days of shopping centers are over, now it's about mixed use. I think the case is shopping centers are by design actually mixed use assets in a way, with a very diverse tenant mix that's ever evolving and never stops. And probably commenting on some of the other ChatGPT buzzwords that you raised, Klaus, I think it's all pretty true. It's all accurate. This is what we see: experiential retailers, grocery anchors, off-price retailers, health and wellness. This is exactly what's happening. Retail is ever evolving. That's the nice thing about our industry. And so key is to own flexible places, because we know for sure it will continue to evolve. We have no clue how the landscape looks like in 20 years from now. We know it's going to change, and you better own pretty flexible buildings that can cope with that change.
That's good. And if I'm right, so you are looking for more, let's say, dense, development in your assets. So why not building a kind of, let's say, resi area on an existing plot?
That's another nice thing. That's another nice thing about retail real estate. It tends to be underutilized for historic reasons. It tends to be underutilized. It starts with the parking. We will see changes in modes of transportation, freeing up parking space that we can use to develop a hotel or some resi or whatever use that fits with a location on a site, or even turn some more space into retail use, medical centers, etc. So the densification and the better utilization of the assets, that's a big theme that will continue and allows actually for growth. Even with assets where you feel like it's fully leased out, you tend to see areas where you can rethink it and show growth.
Super. There's two more words left, Stefan, which is maybe something you have to advise to your companies as well. So which is kind of, let's say, e-commerce integration or technology integration or e-commerce activities. Something you would also see as a part in our industry that has to be considered, and how should that be handled from your point of view?
Who would I be now to argue with ChatGPT? It's a bit like Kasparov in 1990 something, 6 or 7, playing chess against Deep Blue, and suddenly a computer beats the best chess player in the world. And so ChatGPT collected some truth. I don't think it's dangerous to combine everything that ChatGPT puts in front of you, because that combination in this case would mean you would have to combine outlets with groceries. And so this is just something which has 2 completely different functions. So it needs a bit of human brain to really work with that output. And I think one thing got completely overlooked, and your question was, who are the winners in retail in the next cycle? And I think what ChatGPT completely overlooked is, and I don't say these points are relevant, I'm a big believer of mixed use potential and the fact that our whole industry underestimated that for the last 20, 30 years. And there are enormous synergies with surrounding users, and then we can be better, definitely. But what ChatGPT completely overlooked is as a winner is standing assets that show resilient performance and that have just gone through that crisis, where other assets have, given away market space, where shoppers and retailers decide these are not relevant anymore in the future, and we will now gather around a certain quality of asset. And this will be the winners, from my point of view, in the future, because they will be almost fully occupied. You will have an option as a landlord to optimize their tenant mix. Retailers will be frequented by visitors. Cities will not have halfway vacant shopping centers in their inner city if we talk about that kind of assets. So the winners are the investors, the winners are the retailers who will make good turnovers, the winners are the customers who get a nice shopping ambience, and the winners are the cities who don't have a big ruin in the heart of their inner city. And I think such assets are around and we need to dig them out. But, we can look at KPIs together and see where these assets in 2018, in 2019, how have they weathered 2020, 2021, 22, that post-pandemic season, and how are they holding up in this additional storm that we currently go through in Europe. And I'm convinced they would be a good investment.
Thanks for all the answers you have given to that. ChatGPT, which is a very modern style, that's a opportunity to have a look into our industry. Let me give you one more, let's say, more funny comment concerning mixed-use developments. Even in medieval times, all retail has taken place in mixed-use buildings because the logistic has taken place in the back, the production as well, and the shopkeeper has lived upstairs. So that was the beginning of, let's say, retail real estate a long time ago. It is unbelievable, dears. It's just 3 minutes to go, and we have only one chance, everyone 1 minute for last round. So please give the audience and us the chance for 3 recommendations how you would cope with the current situation and where you would love to invest. Rüdiger, would you love to start? Rüdiger, you're unmuted.
Disciplined doesn't help always. So no, I think what I would hope for is first of all, I think that, and that's also missing in your ChatGPT, and it's typical for it, is the human factor. I just hope that the team I'm working with and that will stay together. I think people still make the difference, not machines, and therefore I'm looking forward to this year also to work with our team and conquer, let's say, a bit more the market. More concretely, we would hope to be able to acquire a product within our region, and it looks good as more asset and really good assets seem to come to the market. So that's what we're hoping for, and to roll out actually our growth story over the next 12 months. That's what I would hope for. And I would obviously also hope for that, let's say, this does not happen only positively in my part of Europe that I'm operating in, but in the whole rest of Europe.
Thanks for that. Stefan, your commendation?
Well, first of all, I would start with psychology and say, let's not hide the retail badge in the market anymore. So there are other asset classes who also have challenges, and I've met quite a number of super professional people dealing with the challenges in the retail industry, and so we can be proud of what we've mastered, and I think it's an interesting moment for us in the cycle, and we should stress that. And I think building up positive expectations that the market will move in our favor. And as an asset class, I mean, it will be an asset by asset analysis when we look at the subsegments. I personally find outlet malls super interesting. But again, there's also in the shopping center sector, there are some pearls that people have ignored now for a number of years, and I think there's value.
Super, thanks for that. And it's up to you, Volker, for some last recommendations for our industry.
Thank you, Klaus. So my advice would be, don't miss the opportunity. The time is now. It's something that Stefan highlighted earlier in this call. If we wait until everything has balanced out, the opportunity, the window will be closed. I think the time is now. We have some 2 or 3 great vintage years ahead of us to invest in retail again after the market has like fully repriced and rebalanced. And when looking at potential investments, my advice would be focus on quality. We are still in a polarizing market environment. It can be tempting to look at stuff that looks cheap, that works out great on Excel, but is actually probably a deteriorating asset. I think the opportunity is to acquire quality assets at decent pricing. Quality seems to be undervalued, whereas some deteriorating assets might still be overpriced. This is my take on the market and would be my advice to investors.
Thanks for that. Great last words. Unbelievable. There's a huge number of questions left. Unfortunately, the time is over. I thank you very much for that great insights, for that great discussion. I think very, very valuable for all the audience and the people who have listened at the screens or wherever they are. Thanks for that. I now hand over back to Reinhard for the last words, and I hope to see you soon.
Yeah. Many, many thanks. It was wonderful. It was extremely exciting, informative, and very optimistic. And I think this was very good, very good. Thanks to all of you for so many valuable ideas and inputs we can use for our future editorial work. And as mentioned at the beginning, we will send out a summary, text and video within the next days. Many thanks to you, all the panelists, and many thanks for so many people watching us. We hope to see you soon at another Across Retail Talk. So from my side, greetings from Vienna and goodbye.
Bye-bye.
Bye-bye. See you.
Thank you.
Bye.